avoids market failures and their attendant risks. A properly laid out regulatory framework that is implemented consistently and transparently is more often than not a bulwark for a strong and sustainably growing market. Every financial crisis, not the least the recent great recession, had shown that the cost of putting in place firefighting equipment is much lesser than cost of fighting a fire in the absence of firefighting equipment. While talking of regulatory convergence, the recent proposals of the Reserve Bank to bring changes to the regulations governing the microfinance activity can hardly be overlooked. I think the harmonization is very important, as different regulations governing the same activity brought complications. The proposals also recognize the tremendous progress made in credit information reporting system post the report of the Mulligan Committee's report of the Committee on MFIs chaired by Mr. Mulligan. When these are formalized, I feel there will be greater order in the MFI segment, enable the NBFCs to harness their market potential even. As per the Reserve Bank's 2020 report on trend and progress of banking in India, the credit intensity of NBFCs, that is NBFCs credit to GDP, grew consistently from 8.6% in 2013 to 12.3% in 2019, before moderating to 11.6% in 2020, largely because of the pandemic. In fact, between 2019 and 2020, the non-food credit of banks as well declined from non-food credit to GDP of banks also declined from 51.3% to 5.7%, indicating the overall decline in the economic activity in the country. The NBFC's credit grew by an unsustainably high 32.6% in 2018 and moderated to 17.8% in 2019 and further to 1.9% in 2020. High deceleration in 2020 could partly be, I'm saying partly be, because the customer segment catered to by the NBFCs are more vulnerable and hence felt the impact of the pandemic with greater intensity. An RBI staff article, which was published in a recent RBI bulletin, based on a sample data, worked out the year-on-year growth. The consolidated balance sheet of NBFCs will be 13% and 11.6% in Q2 and Q3 of financial year 2020-21. While this represented a deceleration as compared to the data for the similar period the previous year, understandably due to the impact of the pandemic, the double-digit growth, even in the adverse macroeconomic conditions, is a pointer to the resilience of the NBFCs. The paper attributes this to the ability of the NBFCs to cushion the impact of the pandemic through quick adoption of technology, policy support, and strong fundamentals. The paper further notes that while 70% of the NBFC loans were for a tenor of 1 year or more, there was a 2 percentage point increase over just 3 quarters in the loans that had a maturity of under 3 months, indicating the ability of the NBFC sector to cater to changing needs and alleviate the problems of people who had short-term financial difficulties created by the pandemic. So it's an important role that the NBFCs were able to play at the time. There are, of course, indications that the delinquent loan portfolio will continue. However, India Ratings has pointed out that the NBFCs and HFCs have enough cushion to deal with the challenges during the second half of the financial year arising from the impact of the pandemic on their collections and disbursements. This is based on the fact that the system has adequate liquidity and sufficient capital buffers. Due Due to these factors, the rating agency has upgraded the outlook for the NBFC sector for 2022 to improving from stable. Similarly, an ICRA survey, another rating agency, which surveyed 65 NBFCs accounting for about 60% of the AUM of the sector, shows that 74% of the surveyed NBFCs expect to post a growth of over 10% in 2022, financial 2022, and 42% projected a growth of over 15%. These show that the NBFC sector is ready to harness the growth potential as the economy is coming out of the ill effects of the pandemic. And part of the credit for this should go to the enabling environment created by the regulator, backed by strong regulatory and supervisory measures. In fact, the India rating report does allude to this. Obviously, the other part of the credit goes to the sector. RBI has taken a slew of measures to support the NBFCs and ensure adequate flow of funds to them, including, of course, the decision to grant PSL tag for bank loans to NBFCs for on-lending to specified activities and sectors. While there is a move towards greater convergence in regulatory framework, there are still areas where NBFCs have greater flexibility. A strong regulatory framework, the successful resolution of a large HFC, and a host of measures to ensure adequate flow of funds to the NBFC sector, strengthening the co-lending model, all this on one hand, and this combined with the ability of the NBFCs to be nimble-footed and flexible, mean that the sector has a lot going for it in the ecosystem. While the ecosystem is shaping well, grabbing the opportunity by being responsible, accountable, and undertaking the business, the culture that encourages compliance in letter and spirit, is in the hands of the players in the sector. As Deputy Governor Mr. Rao pointed out in his CI address, and I quote him, quote, this is his book. Let me conclude by saying that non-banking financial sector is at an inflection point right now. From here, the entities which put interests of the customer above everything else are responsible while innovating and have strong governance culture will thrive, while others will fade away. The Reserve Bank has been carrying out calibrated modifications and adjustments to mold the NBFC regulations with changing. I want to conclude with a couple of sentences on my own, hopefully, and discussion. On my part, I want to conclude by saying that there is potential and opportunity. And to that extent, is there advantage? Is it advantage NBFCs? Yes. And the game's rules are designed to win by following the rules and by not violating or circumventing. I do hope that the ensuing panel discussion will unfold the ways of doing that and using the advantage to the benefit of the economy and the customers, both of which will ultimately benefit the NBFC. For me, it is the ecosystem says advantage NBFC, but it is in the hands of the sector to make use of that advantage for their benefit, for the economy. The latter two result. That's the one. And I want to thank all of you patiently.
Yeah. Thank you, Mr. Vishwanathan. So the former Deputy Governor, Mr. Vishwanathan, says it's advantage NBFCs. Well, it must be music to the ears of the 6 gentlemen participating in the panel discussion. Mr. Vishwanathan mentioned or referred to current Deputy Governor, Mr. Rajeswar Raw's recent speech delivered at CII, where he spoke, where he said that the NBFC sector is at an inflection point. For the record, there are 9,651 NBFCs as on March 31st, 2021. These NBFCs, and including the housing finance companies, have loan assets worth about close to rupees 54 trillion, roughly 25% of the banking sector loan assets. And over the last 5 years, the NBFC sector assets have grown at a cumulative average of 17.91%, close to 18%. Well, let's come back to today's discussion, Advantage NBFCs, or rather, is it Advantage NBFCs? Just about 3 years back, or 2 years back exactly, 2028, this sector was completely written off. And suddenly we are talking about Advantage NBFC. Primarily, the key reason is there's a liquidity sugar rush. That's during the pandemic, what Reserve Bank of India unleashed that liquidity. And that has brought down dramatically the cost of funds. I mean, the CPs and CDs, 1 year, 2 year, 3 year money is being raised at a historic low. And that's what the main advantage comes from, because the NBFCs, unlike the banks, they don't have the reserve requirement, they don't have the capex for those establishing the branches, and their operating cost is far lower. So that's the first question. It's not a question. I would ask each of you to give a preliminary remarks and for a few minutes, and then we will get into a few rounds. Who are there to join us? Just alphabetically, Gagan Banga, India Bulls, is yet to join. Jairam Sridharan, technically, officially from Dhyan Housing, but it's in the name will be changed soon. So he's from Piramal Group. Jaspal Bindra, Centrum, Keki Mistry, HDFC, Rajiv Lochun, Sundaram Finance, and Sachin Vansal, Navi Finsab. And the audience, you must be looking at this, how carefully this composition has been crafted. We have Jairam from Dhyan Housing, who has been in the news. Jaspal is 1 foot in banking already. Unity SFB, I don't know, but I'd like to believe very soon it will be launched, new SFB, which is taking over the PMC Bank. Sachin Bansal is a license seeker, banking license. So that's the very, and we have Gagan, Gagan India Housing, which actually had applied for a banking license, sorry, not applied, actually wanted to take over a bank and had a bit of a difficult past. That's 2018 I'm talking about. So let's ask Keki first, and Keki happens to join. I mean, it's being got recorded because as we speak, as this function is on, Keki is at the board meeting of one of the group companies. So over to you, Keki. Is it Advantage NBFCs?
Well, Tamal, if you ask me, I don't think there is anything like Advantage NBFCs or Advantage banks. I think both NBFCs and banks have a role to play. Both of them have their plus points. Both of them have their negative points. So I don't think there is any particular merit in saying that it is Advantage banks or Advantage NBFCs. I don't agree with that at all. Yes, liquidity is there. Liquidity is available to everyone in the system. It is not only to NBFCs. It is as much to banks as it is to NBFCs. The banks are also a beneficiary of the lower cost of funds that is prevalent in the economy today, just as NBFCs are. Now, coming a little more specifically, I know this is more general discussion on NBFCs, but coming more specifically to HDFC, fortunately, because of our AAA rating for the last 30 odd years, we have always been the beneficiary of getting funding at costs which are in line or lower than the cost of funds for most other institutions. So that gives us a little bit of an advantage, but that is not because we are an NBFC. It is just that it's the strength of the balance sheet, the fact that we have a very high capital adequacy ratio, number one, and number two, there is that additional comfort that a lender can have when they give money to HDFC.
Well, we heard India's largest housing finance company. Let's go to a pure play NBFC, Rajiv Lochun, Sundaram. Advantage NBFCs?
Thanks, Tamal and Business Standard for thinking of us and having us on this panel. I tend to echo Keki's view. It's unclear whether it's advantage one group versus another. I think it's much more opportunity NBFCs. And as Mr. Vishwanathan said in his opening remarks, it's very much how we choose to use this opportunity or whether we choose to squander it away. And therefore, it's very much in our hands. If I sort of step back and look at the next decade and a half of India's growth and prosperity, I would argue we're entering a golden period that we look back in over many decades as one that transformed the country and made it sort of get into the superpower status. And so that affords, I think, a tremendous opportunity for all financial services firms, banks, non-banks, and other financial institutions to play a very meaningful role in shaping the trajectory of Indian economy. And therefore, I think for NBFCs, it's a tremendous opportunity. And every market participant who's organized themselves well should see this as a tremendous opportunity as well. Therefore, I would say it's very much opportunity NBFCs, and whether it translates to advantage NBFCs depends very much on how we think about obsessing about our customers. Serving the customers needs to be the first and foremost sense of purpose and mission with which we operate. We do need to take advantage of the tectonic shifts that are happening in technology, in digital, and in data to drive the kind of innovations that our customers in their geographies and communities seek. And that sense of purpose with which we deliver financial services and products to these customers in many ways will separate the men from the boys or the wheat from the chaff, if you want to keep it politically correct. Lastly, I think there's a tremendous amount of regulatory support that is being put in place. I think these guardrails will serve us well. And so all NBFCs that are able to set very high standards for governance and very high standards for compliance will automatically be able to convert the opportunity that's available to us into an advantage. So in summary, I would therefore say for NBFCs, it's a very unique confluence of factors that creates a unprecedented opportunity to drive growth and prosperity for the country. If we approach it with a sense of purpose and mission that we've always done over the past several decades, I think it will convert into advantage NBFCs.
Thanks, Rajiv. So Rajiv says the opportunities for NBFCs, and it's up to the sector to interpret. I mean, to move ahead and see the advantage. So let's ask Sachin, because I guess that you'd have a different perspective because Sachin, you have applied for a banking license. So over to you.
So Tamal, I agree with Rajiv, what he said. I think there are well-run companies and there are not so well-run companies in every sector, right? So the same way there are well-run banks and not so well-run banks, and there are well-run NBFCs, right? So if you are a well-run company, you have an advantage, right? So I 100% agree. I think the environment is very conducive. As an outsider who came into this sector couple of years ago, I have seen that regulator is extremely positive minded. They want the same thing as us, which is a large, prosperous financial services sector. I found that to be extremely encouraging. But at the same time, I see that banks largely are leaving a lot of opportunity on the table, right? So they are, from a use of technology perspective and from a customer experience perspective, there is a lot to be desired when it comes to banking in the country as of now. And I think that's where sort of nimble NBFCs like ours can come in and have some advantage mainly because we are a bit fast as compared to banks, which tend to be a bit slower in their adoption of technology. And so I think if you are willing to work at it, I think there's a lot of opportunity. The market tailwinds are behind you if you apply the right solutions and keep your eyes on the customers while you are doing it. Right? So I think at the same time, I think the sector is kind of especially when it comes to at Navi, right? What we are trying to do is that trying to see if we can fundamentally shift the consumer experience to a level where it has never been seen before. I think we believe that finance is a purely digital product. The amount of physical intervention that should be required to get finance to in the hands of the users should be zero or close to zero. And that's the future which we are envisioning and which we are building towards. We're growing fast. We have got a lot of encouraging response from lenders, from regulators, from customers. I think there is next 10 years is going to be golden years when it comes to financial services in the country. And there is a lot of work to do.
Okay. Yeah, thanks, Sachin. I have a tough day, I must say, today, because everybody is so diplomatic and everybody is, saying so many good things about the regulator. You can't afford to be critical, and I don't want to be critical. But yes, I mean, being in the financial sector, license seeking or changing from NBFC to bank, so you have to say good words, be a little diplomatic and advantage, and doing for the nation, for the country, for the economy, etc., etc. So my challenge is how to make it more interesting. But let's see. Let's ask, Jairam. So tell us, you are in the news because one of those very interesting takeover that you have gone through to the insolvency process. Technically, you are representing Beyond Housing, which will be a Piramal group of companies. So let's say that you are representing Piramal Group in the non-banking financial segment. So Jairam, tell us your preliminary remarks. Don't be diplomatic, just be a little more frank.
Okay. Thank you, Dhamal. I'll try and keep things interesting. See, I want to start by offering three observations, a little bit data oriented, and it'll help us give shape to kind of what the NBFC sector in India today is. Firstly, it's important to understand that NBFCs, as we understand it, are a somewhat uniquely Indian phenomenon. This animal doesn't exist in most parts of the world. So we, Deputy Governor spoke earlier about some observations of the FSB. FSB, if you look at FSB data globally, and you see what happens to non-bank financial assets, right? How large are non-bank financial assets in various parts of the world? Firstly, India has amongst the largest percentage of non-bank financial assets in the world. That's number one. Number two, within that non-bank financial assets, if you look at composition, in most of the world, almost entirely, it is made out of funds. No part of non-bank financial assets is made out of leverage-oriented, publicly held sort of balance sheet institutions like NBFCs, right? In these types of institutions, so-called credit companies, are on average about 12% of non-bank assets globally. In India, that is 75%. So that tells you that this phenomenon called NBFC, which is a levered entity, which does balance sheet lending, but is not a bank, and is of large scale in lending, is a uniquely Indian phenomenon. There is no NBFC like NBFC like it, or very few NBFC like entities in most parts of the world. That's observation number one. Observation number two is, why is that? Why does this thing exist in India? This thing exists in India because India has too few banks. In my mind, and that's observation number two. Now, a country like the United States has 4,913 banks last we counted, right? 4,913 banks in the US. How many public and private banks are there in India? 34. So 4,913 versus 34. So an economy which is 11 times our size has 145 times our number of banks, which tells you that we are severely underbanked as a country, which leads me to observation number three, which is you are looking to become a $5 trillion economy. Today, you are give or take about a $2.7 trillion economy. For a $2.7 trillion economy, you have total credit in the system of about $2.6 trillion, right? So about 97% credit to GDP ratio, give or take, something like that, right? That's our size. For you to get to a $5 trillion economy, you need to get to about $6 trillion in credit. So from our $2.6 trillion, you need to get to $6 trillion in credit. Now you look at where public sector banks are, how much growth can they actually show from here? How much incremental capital do they have to actually grow from here, right? You take the 4, 5, 6 large public sector banks and you look at how much growth they have. You put it all together and you have line of sight to about $1.5 trillion extra credit in the coming few years. Where is the rest going to come from? You need that additional credit in the system for you to even create a $5 trillion economy. Banks, as currently structured in India today, with the number of banks that exist, cannot do it. Which is why you have to have some non-bank institution. And as I said, in India, 75% of the non-banking sector is this NBFC structure, right? And I'm including HFC in that, right? So that's why I believe that for us to realize our dream as a nation of becoming a $5 trillion economy, it is an imperative. There is actually no other way but to see large NBFCs emerge and NBFCs actually grow quite significantly from where we are right now.
Thanks, Jairam. Gagan is yet to, Gagan Banga of India Bulls yet to join. I just got a message. He's actually in Edinburgh, UK. So he'll be joining soon. Let's hope he can join us. But Jaspal, you are the man in the news. All of you are, all our panelists are for some reason or other in the news. But Jaspal, you are most, you are on the hot seat kind of thing, because all the PMC depositors are waiting. When do you announce? Waiting for your announcement. So yes, tell us what's your preliminary remarks, and also if you give us a sense, when do we see your bank coming up? Unity Small Finance Bank. Over to you, Jaspal.
Thanks, Tamal. Tamal, let me break up this NBFCsAdvantage chronologically. I think there was a situation pre-late 2018 when it was en masse Advantage NBFC for any size, any vintage, any governance, quality, etc. And I think then late 18 to 2020, I think barring a handful of NBFCs, it was disadvantage NBFCs. NBFCs became a four-letter word, and it wasn't really the right thing to be. And I think 21, we are seeing again Advantage NBFC, but with a difference this time. I think there is a little bit more selection this time. It is Advantage NBFCs relatively in availability and cost of funds for everyone. But I think beyond that, the highly rated, the better vintage, better governed entities are actually getting the real flow of the benefit. And so I think, yes, it is sort of more different in texture, let's say, than it was pre-2018.
Yeah, and the second part, Jaspal, you want to talk about when is your bank coming up? I cannot force you if there is any regulatory issue to talk, but being a moderator, I'm sure the audience would like to know, because you are in the news. So would you like to say anything or no?
So sure, there's a two-step process, Tamal. We will commence business in Unity Bank very shortly. We're talking days here, days or a few weeks maximum. But then the PMC amalgamation is probably some months away, a couple of months maybe. And so really, but well within this calendar year, we should be done.
Thanks, Jaspal. So India is set to get yet another small finance bank. And incidentally, the Business Standard BFSI Summit on SFB small finance banks is day after tomorrow. So do tune in. Let's talk about, I'm not getting into the scale-based approach, which Reserve Bank of India Deputy Governor has recently spoken about. But let's talk about, capital. Even though RBI norms say that you need to have a 15% capital adequacy ratio, but the rating agencies expect you to have more. And unless you have more than 15% or adequately capitalized, you don't get better rating. And unless you have a better rating, you can't borrow cheap, which the very premises of today's discussion, the advantage in BFC, because there is cheap money, the regulatory sugar rush. So is it true that capital plays a key role and the 15% is not adequate? Let's ask Keki once again. Mr. Mistry? Sorry.
I don't think so. I don't think so at all, Tamal. Yeah. We as HDFC raised capital last year, and by virtue of raising capital, our capital adequacy now is 20% plus. But traditionally, to my mind, 15% capital adequacy is more than adequate. It's just not capital adequacy that a rating agency would look at. A rating agency would look at a whole host of other issues. They would look at the inherent strength of the balance sheet. They would look at the asset cover that you're carrying. They would look at so many other factors. So I don't think capital adequacy itself is that relevant. And to my mind, the 15% capital adequacy is very, very adequate. You must understand, Tamal, that the capital adequacy which arises out of a debt equity ratio or a leveraging, as you call it, is ultimately resulting in an impact on your return on equity. So you got to balance between capital adequacy and return on equity. The normal, traditional accounting norm is that the higher the capital adequacy, the lower will be your return on equity. The lower your capital adequacy, the higher will be your return on equity. So you got to balance both these factors.
Okay, so let's each of you, if you could tell us that how critical is this capital? Yeah, there is a you can swim in liquidity, but it's not exactly that easy that the way I am projecting it. Yeah, Jairam, I am seeing you nodding. So tell us, how critical is the capital?
I think you're absolutely right, Tamal, that there is a lot of liquidity in the system right now. I mean, RBI's data shows that we have consistently been somewhere around 7 lakh crores of surplus liquidity in the system for the better part of the last year and a half. Surplus liquidity, and India is a country where for many, many periods in the past we have been deficit liquidity and we have run negatives. Now we have been running plus 7 lakh crores for Lord knows how long, right? Having said that, I'm very much in Keki's camp of saying that liquidity and capital adequacy, etc., are sort of one element of what you require to actually be really successful. Let's take Piramal as an example. Piramal today, we have a capital adequacy upwards of 30%. Right now, it's an insanely high level of capital, to be honest. And when you're running 30+% of capital adequacy, as Keki was saying, your return on equity is going to get subdued. And that is something that we got to recognize, that today, after the last year and a bit, when everybody was worried about credit, every financial institution in India went out and raised capital. So everybody is running capital adequacy ratios significantly higher than what they were running 2 years ago, right? So everybody's ROEs are suppressed, capital adequacy levels are very, very high. So the need at this point is not more capital, the need is more leverage, and actually using that leverage to go and satisfy credit needs out there. Banking sector credit is today's credit deposit ratio is 70%, the lowest it has been in a couple of decades. So essentially people are swimming in capital but are not lending enough. And that's what we need right now is to go out and lend. And so people like us who have a whole lot of liquidity and a whole lot of capital, very high capital levels, are thinking now is the time to really start getting aggressive out there in the market and start lending, because that's the only way that you will improve your return ratios as well as participate in the upturn in the economy that we are likely to see in the coming years.
Thanks, Jairam. Yes, we'll talk about credit uptake and is there any demand, etc., etc. But let's hear Jaspal. What's your take on capital? Even as we speak, you are a non-banking finance company, but you are migrating into banking very soon. So, how critical is the capital? What kind of capital you are carrying yourself? And tell us.
So, I think at a point in time, capital. We've heard both. Jairam and Keki and I agree with having the right balance of capital rather than having too much or too little. And I think the issue is that we've seen on several occasions in the past that people have been caught wrong-footed, not having sufficient capital because they were loath to dilute. It was the greed of shareholding that led to that phenomenon. Now we have somewhat the reverse, where we have too much capital and then a very strong desire to be aggressive lenders in a quick span of time, which in itself is a risk in my estimation, because most of the accidents we have seen have happened when people were too eager to lend too much too quickly. I think that has a risk. So I think finding the balance part for each one. In our case, to start with, we are going to be abundantly capitalized. Also a little bit to give the comfort or the lack of the trust deficit that has developed on the PMC depositors' mind with the old institution. We want to tell them we are different, and that's why we are going to come a little bit overcapitalized, significantly actually overcapitalized. But I think that is not the strategy forever. That is a one-time starting point just to give them the initial comfort.
Thanks, Jaspal. I can see Gagan has joined. Welcome, Gagan. Gagan is joining us from UK, Edinburgh. Gagan, I think you just so keen probably hear them. So I don't want to bring you right away. I'll just wait so that you are I mean, you hear what others are saying. I'll get back to you very soon. So let's hear. Sachin, tell me how critical you see the capital now at this point of time as an NBFC. And of course, you will become you are a license seeker. So at that point of time, there'll be other regulatory requirement. But as of now, tell me, is 15% adequate or you need more capital? How do you see?
So Tamal, as of now at Navi, we are overly capitalized. And as a strategy, because we are a startup, we need to make a mark, we need to make a brand for ourselves before we can go out and increase leverage and do that, right? So our excess capital gives a lot of lenders comfort to work with us. We are growing fast, of course, because our base is very small right now. So we will grow fast for a while. And over time, but I think in the foreseeable future at Navi, I don't see us getting to the limits of leverage, I would say, right? So we will stay overcapitalized when we become a bank. Also, we will start off as a very well capitalized bank over time, and over time we will increase the leverage.
Thanks. Thank you, Rajiv. What do you, Sundaram? Yep.
Thanks, Tamal. We have a slightly different take on capital adequacy. We are 67 years old. And if you look at the last 25, 30 years, pretty much any metric, we've compounded at between 15 and 20%, assets under management, profits, market capitalization. So there's that 15 to 20% kind of corridor in which we operate. And we've never had to raise capital at all. All our growth has come entirely from internal accruals. It does build a certain amount of speed governor within the organization. Some would argue that's a good thing. Many might argue, particularly in this day and age, that that's not such a good thing. But I think it's helpful to take a view and remain consistent to your philosophy. And ours has been sort of a prudent balance between growth, quality, and profitability, that time-tested trinity that has worked well for us. And so in many ways, we see capital adequacy as a consequence of the actions that we take, and we ensure that stays above the regulatory limit. So to that extent, I completely agree with what Jaspal said and Keki said earlier. I think 15 is pretty good, which is what the regulator requires us to hold. Given how environment operates, we might go up or come closer to that 15% level. But frankly, we see that more as an outcome rather than an arrowhead metric that we chase.
Okay, thanks. Let's bring in Gagan. Gagan, you missed out the first part. And yeah, thank you for joining, despite not being in India. Gagan, you spoke about the first preliminary remarks. That's what I would like you to do. This is essentially, is it Advantage NBFC? 2018 was a time when that sector was almost written off. I mean, we saw the death of a few NBFCs. And as someone said, that NBFC overnight became a four-letter word. But now things, since then, things have changed, and it looks like everything is so bright and so much of optimism, and there is so much of money, cheap money one can raise. That's what the NBFCs are doing. So, is it back to business? And that's it, Gagan.
Yep, Tamal, thanks for having me over, and it's nice to have such great panelists around me. It is Advantage NBFCs in the context of India. I feel that given the large asset side opportunity that we have, it is Advantage or lenders. It's all about who focuses on the right niche segment which is there for them, or there are certain mass lenders, and there would be periods of volatility. So there would be periods of steady state, and then all businesses, and irrespective of the size, would swing towards a period of volatility. The issue becomes when the pendulum swings the very uncomfortable way, which is existential crisis. Which was clearly there for NBFCs for almost 2.5 years. And I'm grateful that, the central bank reacted with great maturity, handling the short term, the medium term, and now the long term. and giving an impression that NBFCs are not light touch country cousins of banks. They are well-regulated entities, and for those who choose to abide by regulations, the future is certainly very, very bright. Coming to the point of capital that some of my co-panelists were speaking, yes, there could be a differing strategy where one could be going by internal accruals, and if you can manage that, it's actually quite amazing that one can manage to grow with internal accruals. It is perhaps why Sundaram is such a well-respected name in the industry, because it has managed that for the longest period of time. For companies which do not have as long a history as Sundaram, perhaps we don't have that flexibility, since as Rajiv rightly said, one has to follow the principles laid down. We follow a principle where, over our 12, 13-year history in the sector, we've never gone below 20%. We currently operate at 30%. And my take on the recent RBI regulations and whatever is, RBI is more setting the floor. And it's a nice floor to have at 15%. It gives comfort. But essentially, practically everybody on this panel will agree that our capital adequacy is more an outcome of what rating agencies desire and not what RBI. RBI is more setting a floor. And in the revised world of NBFCs post the crisis, I doubt NBFCs can go back to the era of 6.5, 7 times gearing. We will all have to recalibrate our business models to between 3 and 4 times gearing. And whatever is the consequential, if we are targeting high credit ratings, if we are, and if you don't have high credit ratings, then there is anyway no access to the debt capital market. So if you're targeting high capital ratings, credit ratings, my sense is that capital adequacy will be certainly north of 20%, if north of, on a practical basis, if not north of 25%. There is no running away from that. The bank side of it, I don't understand that as well, but certainly for NBFCs, I would imagine the real floor is more like 20 and not 15.
Thanks, Gagan. This is that's what my question in the second round, that yes, Reserve Bank of India stipulates 15%, but actually it's the rating agencies, they tell you how much more capital you need to get a better rating. And only when you get a better rating, relatively better rating, you can raise cheap money. So one related question to all of you, and I'll start with Gagan only. So, 2018 crisis, many of us said that it's a sort of Lehman moment for India, but I personally felt that is a Northern Rock moment for India, essentially the asset liability mismatches. So 2014, 15, 16, around that time, there was liquidity, not as much as we could see that, but there was cheap liquidity, and many of the NBFCs got tempted and they got into the asset liability mismatch and over leveraging. So Gagan was brutally frank. So tell us now, things have changed, and what are the lessons that has been learned, and what are the corrective measures?
So from our perspective, we continue to believe, and there are more disbelievers to this theory than believers, that I am a strong believer that for companies which are as well capitalized as most well-rated NBFCs have even historically been, and the capital adequacy levels have only improved, unless you may even have done dumb lending, you will never blow up because of asset quality issues, right? Because you're sitting on 20-25% capital adequacy. It is highly, highly unlikely, unless you've done outright frauds in your system, that you're ever going to blow up because of asset side issues. We have forever believed that the existential risk on NBFCs comes from the liability side, and liability side has multiple type of risks. There is a ALM risk that several of NBFCs created. There were no liquidity buffers, even though ALMs were matched, but there were no upfront liquidity buffers. There were certain refinance assumptions which were built in, which fall off in periods of crisis. And what we at least I can say for myself, what I had not appreciated was the pro-cyclicality of the debt capital markets, or a large component of the debt capital markets, and the rating agencies. Now, with the benefit of hindsight, one clearly believes that the counters to all of this is have moderate gearing. In our case, we believe the appropriate gearing is 3 to 3.5 times only. Work with banks and never compete with banks, because they're clearly having the granular asset base. So collaborate with them. Liability base. Collaborate with them. Become their partners. They have certain limitations on distribution and flexibilities around distribution, which we can bring the last mile credit advantage of NBFCs, which historically was the reason why NBFCs needed to exist. And somehow we felt, as we got to AAA and all of that, there is one HDFC and there can only be one HDFC. Just because you get to a AAA, you don't become anything comparable to them. So one got sort of fooled with all of that. And so clearly the collaborative model with banks and living within your means, operating within a restricted gearing of 3.5 times, if one is able to do it, whatever is the outcome in terms of the business returns to shareholders, that is what one should achieve. Shareholders today are a lot more mature. They are happy with a 15% ROE with no existential risk. Normal business volatility is all fine, but no existential risk, versus a 25 to 30% ROE and an existential risk coming every 10 years.
Thanks, Gagan. I as I said, I'm mightily impressed with your soul searching, with your and the candidness.
Thank you.
Let's hear Jairam and Rajiv quickly. What do you think? What are the lessons learned from the 2018 this asset liability mismatches? Quickly, Jairam.
I think the point Gagan made is absolutely critical here. Like with the fact that well-capitalized institutions rarely ever go bust on the asset side. It's always the liability side, and it's always liquidity. That can create life-threatening issues for you. Or one of the things I often like saying internally is that liquidity is like oxygen. It's not enough to have it 99.9% of the time. It's critical that you are fully covered from a liquidity standpoint, right? And clearly many institutions underestimated the vicious power of liquidity to kind of to bring you to life-threatening situations. And this always gets exacerbated when short-term money is going cheap. Everybody gets lulled into believing that I can just keep borrowing short and lending long, and I'm making the tenor margin over and above whatever I'm making as a credit margin. But that story just doesn't last long enough, and inevitably it comes to a tumultuous end, which is what we saw happening in 2019. And as we sit here today with so much surplus liquidity in the system right now as well, and we see some pockets. I mean, think about it this way, Tama. Today, what's happening? The government of India is borrowing 10-year money at let's call it 6.25, and the average common Joe of India is borrowing 30-year money at 6.5. In the form of 30-year home loans. It's a ridiculous situation that we are in today that tells you that there is a lot of when liquidity is flush, a lot of these things happen. When you can get a little bit carried away and you just don't have enough margin of safety left, with you, and it can cause you sort of, trouble in the long run. Thankfully, right now we're not seeing a lot of, short borrowing, long lending thing, but we were seeing that to the hilt between 2017 and 19, and clearly caused a whole lot of grief to a lot of institutions in the country.
Thanks. Yeah, Rajiv, you want to add anything?
I think Gagan and Jairam have captured it very well. I'll just make one point that I think every organization tends to have, a biorhythm and a clock speed that we ought to operate at. And as intermediaries of risk, I think it is important to ensure that we are all marathon runners. And while there might be temptations to sprint in between, we all know what happens when a marathoner sprints, right? Typically, there's a cramp or there's a dehydration or you trip and fall and hurt yourself. So I think figuring out that clock speed and sticking to it for the long-term sustainable growth rate that you like is, we think, what works. But the lessons, I think they've captured quite nicely. Thank you.
Okay, let's quickly get into something else which everybody wants to know: the COVID pandemic. So, is the worst behind us, both in terms of demand for credit as well as the customer's ability to pay? So, each of you, maybe Jaspal, you can start, and KK will be the last speaker here. Have we seen is the worst is over and credit uptake started picking up, and the loans being the loans that are restructured or turning bad, etc.? That's now almost history. Jaspal, quickly.
So, Tamal, the data suggests that things are improving and improving quite significantly post the second wave. So, I think both in terms of collection, in terms of disbursement to the marketplace, we are seeing strong engines of growth in both sides. However, I would, this is very early days, but and we don't want to believe it yet. But the signals from the UK and from Russia are quite disturbing as of the last 10 days. And should firmly believe that anything in the UK is definitely carried into India. There is enough traffic between the UK and India to believe that if Delta Plus is spread there, it will come to India. So that's just a forewarning, together with the holiday season, festive season, etc., that we should be careful about. So we're keeping our horses in check, but yes, all the data is positive.
Gagan, who is now sitting in UK, so let's hear him. And if you are holidaying, please stay safe. And tell us quickly, when it's on a serious note, when it comes to India Bulls, you see that the credit demand is picking up. You also raised money recently, and people's ability to, your borrowers' ability to pay is getting better.
Things, Tamal, numbers are constantly improving. What as lenders directly and indirectly linked to real estate, home borrowers, our real estate developers, all of them, in some ways, had the going tough between 2012 and 20, and it's only since 2020 that this macro has changed. The cycle has changed for residential real estate. That is helping. The underlying economy is improving. So clearly, both for the project loans as well as the individual loans, one is seeing a steady improvement in collections performance. The courts, etc., are still trying to catch up with the backlog. So recoveries from loans which have already been classified as NPA, and from where you have to do SARFAESI and do all of that, that is still a tad bit slow. But I hope that in the next 6 months, even that courts will be able to cover up on the backlog. I, in the same breath, while I'm not holidaying here, but in the same breath would agree with Jaspal as I go about, doing my meetings or having meals outside. I believe that there is a little bit of complacency which has come in most of UK. People have let their guards down, largely because of the high vaccine rates. And even though the numbers are very high, people tend to have thought. So to UK's credit, no one is getting seriously ill. People are getting ill and getting okay in a week, 10 days. But that said, there is this risk, and we should remain mindful about both the risk of COVID as well as whenever tapering is going to start, it is going to cause tantrums on the money markets and money flow and all of that. So we have to be mindful about such risks. But things on the ground are clearly improving.
Okay, thanks, Gagan, and safe flight back. Sachin, tell us, what's your take?
Yeah, Tamal, so all the data that we are looking at suggests that things are improving pretty fast.
No, Sachin, not the macro data. Tell from the reality, ground reality, as far as you are concerned. Yeah. Is it really things, or say macro data is phenomenally well? I mean, the last few weeks, every data is so positive, so much of optimism. But we'd like to hear from you people the ground reality.
Yeah. No, so we have a microfinance business, Tamal, and we have a lending business. So both businesses have recovered extremely well from the 2 waves of COVID, and now things, loans that we had written off are also being recovered and being paid back, and so it's an extremely positive scenario, very encouraging for us to scale up. But of course, we are being cautious in our actions. We are not really, going as aggressive as we can, being a little bit less than that. But collections are extremely good, and very, very positive. I think it's just if there is no third wave, I think we are set for a very nice next few years of very nice growth.
Great to hear that, Sachin, and I'm sure things will only get better. So let's hear Jairam and Rajiv. If you can, Jairam, if you can also give some numbers, if you want to tell us. That's 3 months back, that was the collection, and now it is this collection, or 3 months back, this was the credit offtake. Now this is the credit offtake, if you wish to.
Sure. So if you think of February, March 2019 as sort of the pre-COVID peak, if you will, right?
Yeah.
If you compare then to now, on the 2 core parameters, collections efficiency on the one side and credit offtake on the other side, on both of them we are currently sort of at or above those levels. So if you look at collections efficiency, right now the sort of the erstwhile PCHFL book is now sort of upwards of 99% collections efficiency. We were at 98.5 back in February, March 2019, right? If you look at the DHFL book, again, DHFL book is at least 6 percentage points better in collections efficiency now compared to where it was in that period. So meaningfully improved collections performance. In terms of credit offtake, there is a lot of credit offtake that we are seeing. There is a lot of pent-up demand in asset-heavy areas where we are seeing demand come back. So small businesses which have not actually invested now for 2 years, we are suddenly seeing a spurt of activity, right? So I came across this person who runs a small photography shop, or has been, but the photography shop went to bust pretty much because for 2 years, nobody came to a studio and all that stuff. Now this guy has opened a completely two different businesses. He's selling, like, he's become a fruit vendor on the one side, and he's opened a little grocery store on the other side, and he's doing all because his core business has kind of not gone anywhere, and it's and now to do these other businesses, he's looking for capex. Now, for the last year and a half, he just did not have enough courage to go out there and seek that capex, or seek debt to make that happen. But now he has that courage, so he's going and asking for credit. So you're seeing a lot of that kind of credit offtake, particularly in the very small businesses, that people are entering new areas. They are de-risking themselves, and that is requiring them to do capex, and hence they are coming in and seeking credit. So you're seeing a lot of that behavior, and that's increasing credit demand for everybody.
Great to hear that, Jairam. I mean, this is the remarkable entrepreneurial spirit that India has been displaying during the COVID time. I mean, you call it jugaad or whatever you may, but essentially is the entrepreneurial spirit. Rajiv, last what is yours quickly on this? How do you see Sundaram? How does it see?
Directionally, I would agree that things are improving, but there are, I think, several pockets of fairly deep stress. So in our portfolio, for example, if you look at the bus segment, whether it is school bus, where schools have remained closed for close to 2 years now, interstate travel buses, or tourism-related buses, for example, in Kerala, those have not seen any recovery at all, and in fact have gotten worse post wave 2. And those pockets will remain under deep stress. Even our traditional market load operators, right, attached to some sectors are doing well, attached to others in different geographies are doing differently. So, for example, market load operators catering to the cement industry in the south are struggling, whereas north of India, where cement offtake seems to be much better, are doing quite well. I'd say on the growth side, segments like tractor and farm equipment, construction equipment, and tippers, for example, in the medium and heavy commercial vehicle that are attached to infrastructure projects, there's a lot of demand. Small and light commercial vehicles, around e-commerce and related digital delivery, there's a fair bit of demand. But the core sort of MNHCV, the medium and heavy commercial vehicle segment continues to remain somewhat sluggish. The all-time 3-year low continues, and we're hoping there will be some green shoots over the next couple of quarters. So my sense is, headline things are moving in the right direction. We are seeing month-on-month improvements, and we are in the silent period, so I don't want to talk about any specific numbers. Directionally, we're headed in the right direction, but still several severe pockets of stress, particularly in the smaller operators, 1-2 truck kind of operators, smaller self-employed operators without any free assets that depend on the primary vehicle for their loads. That stress continues. We're also seeing that viability continues to remain a challenge. Freight rates have remained somewhat flat. Return loads oftentimes just not available. And diesel prices have continued to remain quite high. So the core viability of many of the smaller operators are under stress. So if you have a free asset or you're attached to a larger fleet, then life is perhaps a little bit better. But for many of the smaller players, they continue to remain under a fair bit of cash flow stress right now.
Thanks, Rajiv. So things are looking better, things are looking up, but there are new challenges. Okay, we are now we have just about 20 odd minutes left for a quick round or two, and then we'll take many questions. Questions are coming. Sachin Mampata, Business Standard, is collating all the questions and sending me. But before that, let's have a quick round. One is this, this buy now, pay later model. I'm talking about the fintechs, actually. I mean, now even biryani for $2,000 you can cut into EMIs and all. So is it a threat for the NBFCs? Of course, not for Sachin and probably even for Jaspal, because you people are sort of, you are the challengers. That's how you're positioning yourself. But let's hear that. Maybe Jairam, quickly, maybe one minute or so. Is it a threat to the traditional NBFCs? And then Jaspal and Sachin, you talk later. But let's hear Jairam and Rajiv and Gagan first. A minute each kind of thing.
Yeah, I would say that I would say that the NBFCs have historically been the cauldron of innovation, product innovation in this country, and that's where all the core products have come out.
I'm talking about the fintechs.
Yeah, so I think BNPL is going to be no different. You're essentially going to see a lot of the NBFCs leading the charge on BNPL, however large it ends up becoming, right? Fundamentally, it is an important product innovation that has happened, and it will take its size of market in unsecured credit, and I think you will continue to see a lot of us, like we at Piramal, we are doing a lot of BNPL business ourselves, and you will see players like us who are kind of relatively new in the space very quickly adapt and come up with BNPL products of our own and participate in this.
Okay. So you're adopting. You don't see it as a challenge. Rajiv, quickly, a minute.
BNPL, I think, is an interesting. I don't know if it's innovation, but to me, it's basically a credit card on a mobile. With a structured payment that happens. So for consumers and consumption-driven spends, I suppose it's a very interesting innovation that we'll see how it plays out. For us, we are not an unsecured credit at all, and I don't see in the foreseeable future us getting into unsecured credit. So no real threat from our standpoint, but it's interesting to stand on the sidelines and watch all the action happening.
Gagan, do you feel threatened by the fintechs?
Yeah, so much like Sundaram, while they do different types of secured loans, we also do only secured loans. So not specifically, but the learning is that they would continue to be technological innovation, and across asset classes, be it unsecured or secured, we all have to remain ahead of the game in terms of technology innovation. So there is a little bit to learn from every technology innovation, directly or indirectly, whether the asset class is relevant to us or not, but there is a lot to learn. So the kind of user interface that some of these BNPL platforms have is very interesting, and we are trying to learn from them to make the user interface for our digital mortgage lending that much more efficient.
Okay, over to you, Jaspal. How do you see the fintech as a threat, challenge, or an opportunity?
So on BNPL, I think it's an opportunity, not a threat at all. The market is so small. It's really, as Rajiv said, it's the credit card to the non-credit card holders. It's 3% of India's population has credit card, 97% doesn't. So it's a very large market. I think it's better to look at it as an opportunity, and who will avail of it better and quicker is the game.
Okay. Sachin, I think you are on the other side, right? You yourself is modeling. You are modeling yourself on that, right? A challenger bank.
We don't have a BNPL product out, Tamal, but I think BNPL and other related innovation that's happening in the unsecured space, and I'm sure there's a lot of other scope as well, and some of it we will launch in the next few months, is basically, the estimate that we have done on our side is that the size of the personal loan market, which is as of now about, I think, $80 to $90 billion in India, should actually be 5 times of this. And there is a lot of informal credit going around. People basically go to friends and family. They don't really go to financial institutions as much. And that is going to change. And a lot of these innovation will actually help in bringing all that credit to formal channels going forward, right? And I think that's why BNPL, we don't know how big it will become, but definitely there is a lot more innovation that is needed in the unsecured space that is yet to come, and a lot of it.
Okay. Okay. Let's hear Keki. What's his take on? Is it a threat? The fintech? Is it a challenge? Keki Mistry.
I'll be very honest with you. In the housing finance business, what you need to understand, Tamal, is that fintech may help in facilitating and improving the process of delivering a loan, or the process of sourcing a loan and things like that. And I'll come to HDFC in a minute, but just talking more generally on the housing sector. What you must understand is that for a person buying a house, it is the single largest investment he will ever make in his lifetime. And because it is the largest investment, he wants to be 100% sure that the property he's buying is right, the developer is good, he will complete the project, he will get good service, his documents will be returned to him on time, and the whole host of other factors that come with it. Customers want to come and meet us more often than we need to meet the customers, simply because they want to have that reassurance from us that, the property they are buying is good and everything is going well. So whilst fintech may have a major role to play in distribution of various other financial service products, where speed, efficiency, quick giving the loan on across the table kind of thing is important, in the housing business, it is far less important than in other businesses. Coming specifically to HDFC, we have been very, very tech efficient right from the time we started. And this is reflected in the fact that our cost structure is the lowest that you will see in a retail financial institution, not in India, probably in the whole of Asia, and probably one of the lowest in the whole world. Our cost income ratio last year stood at less than 8%. Which means that total expenses, administrative expenses, other expenses, salary expenses, all of that put together is less than 8% of our net interest income. Also, interestingly, 88%, if I recall right, 88% of the new loans that we did in the current year of salaried employees came through the digital channels.
Yeah, let me reverse the question and ask, I'll not ask this to Sachin and Jaspal because you want to become bank, but the rest of it, Jairam, Rajiv and Gagan, tell us is, on the other side, is the banks are getting into the NBFC term. The banks which they had not done before, now going to the hinterland, rural areas and getting into the granular loans, be it State Bank of India or HDFC. Banks are doing that. So are the banks a threat? Jairam?
See, I think this is the history of financial innovation in India, right, Tamal? Like, HDFC came up with the real first housing products 3-4 decades ago. And once it became big, banks got into it. Same happened with car loans. The same happened with gold loans. The same happened with microfinance. In every single product category, NBFCs have innovated, created a new product, incubated it. It has gotten to a particular size, and then banks have come in and muscled their way in through much cheaper credit that they are able to give access to customers. That has always happened. It will continue to happen. in any new product category that comes in, if the product category becomes large enough, you've got to expect a product category or geography or what have you. You've got to expect that banks will come in and they will start serving, and that's totally fine. If you've got to go find the next niche, and NBFCs have been very good at doing that over the last many decades. I see no reason why that's going to change now.
Okay, let me ask before Rajiv. Let me ask Keki also, that banks getting into the NBFC turf, the low-cost housing, granular loans. Is that a challenge, Keki?
See, Tamal, banks have been in the house. I'm talking specifically housing now. Banks have been in housing for the last more than 20 years. I would say from the mid to late 90s, when we started seeing the likes of State Bank of India, and then ICICI when it became a bank, and then Axis, and all the foreign banks, whether it be in the olden days Citi or Standard Chartered or whoever, all these banks. But we have held our ground consistently. If you look at numbers which are in public domain, if you look at the figures, let's say for June 2021, the increase in our individual loan book during the year was 14%, 1/4. The increase of housing loans in the banking system, and this is based on RBI data, was less than 10%, which actually means that, contrary to your statement of losing market share, we've actually gained market share in the last 12 months.
Okay, so let me ask. We are now is the last round. No, before Rajiv. Yeah, sorry, I was just keeping you. Rajiv, yeah.
No worries.
Tell us. Yeah, do you see the banks getting into your turf? Like on the one hand, fintech, and the other hand, banks. Do you feel sandwiched or suffocated?
Not at all, right? I think the remarks that Jairam made at the very start and Gagan made subsequently, we are a severely underbanked country. And if we have, and we will become a 5 trillion, 10 trillion kind of economy, and the number of size of banks that we have is far from being able to satisfy the requirements of 1.3 billion plus growing people as we approach a middle income and beyond country, right? So there is a very meaningful role for us to play. I do think we have to innovate. We have to serve the customer in a very sensible way. There are now regulatory frameworks that are in place that ensure scale-based regulations, which are recently out. But more importantly, some of the co-lending frameworks that have been introduced by the regulator are a great opportunity for banks and NBFCs to collaborate, taking mutual advantage of each other's strengths and actually serving the customer in a much more effective way than we could individually. So I don't see banks as challengers at all. Maybe 50 years from now, when we've reached a certain level of saturation with banks, there might be a conversation to have. But I see a long runway where NBFCs can thrive, can support banks in the service of the Indian consumer.
Thanks, Rajiv. So last round we are getting into, and I have just specific questions to each of you about your organization particularly, and what do you want to tell the audience. So let's start with Keki. I have two questions for Keki. One is this, Mr. Mistry, do you see that is HDFC staring at losing a market share? Because on the one hand, all the low-cost housing finance companies, they should be eating into your business, and on the other hand, the investors, the real estate developers, they have other sources than HDFC. There are many investors of different kind. They're happy to put in money there. So over to you, Keki. Is HDFC staring at losing market share?
No, I don't think so. I'll come back to your specific question about developers and about the housing finance companies. But talking of market share, if you look at the numbers which are in public domain, which is up to June of 2021, our growth in our individual loan book during the last 12 months was 14%, 1/4. The growth of housing loans in the banking system, based on RBI data, was less than 10%. If I recall right, it was around 9.6% or so. So contrary to losing market share, we've actually gained market share during the last 12 months. Now, your comment about smaller housing finance companies, what you must understand is that smaller housing finance companies, their cost of funding will always be higher than ours. So if their cost of funding is higher than us, and if their operating cost is also higher than us, which it will be, because they will never have a sub 8% cost income ratio, then naturally to make money, they have to lend at a higher rate than us. If they have to lend money at a higher rate than us, then the choice of customers that they have would be different from the kind of customers who would come to HDFC. And as far as the developers are concerned, yes, they get money from the funds, as you put it, but I'm sure you know that the lending by funds is by extremely high interest rates. So typically, a developer would get funds from a real estate fund at 18 or 19 or 20% or something of that sort. Whereas in the formal system, the lending that someone like us would do to a top quality developer would be sub 10%.
Thanks, Kiki, Vice Chairman and MD and CEO of HDFC. Every question I asked, he just said, no, I'm not correct. My perception is wrong. So let me ask the last question to Kiki. Is this, can you summarize, is it Advantage NBFCs? And finally, if you can answer the classic question which the Indian investors and customers, everybody wants to know, the merger between HDFC Bank and HDFC. Where are we? Or where are you? Over to you, Keki.
All right. So before I come to that, let me say it's not Advantage NBFCs or Advantage Banks. It is Advantage Financial Sector or Advantage Industry. Put it that way. That might be a better way to describe it. As far as the merger with HDFC Bank is concerned, to be very honest, there has been no discussion whatsoever in the last 7 years. Yes, in 2014, we did talk about it, and then we were hoping we would get some kind of regulatory concessions to facilitate the merger, but that did not happen at that time. And after that, in the last 7 years, there's been no discussion.
Okay, so those who are curious to know, where is the merger? Last 7 years, there has been no discussion. That's what Keki Mistry says. So each of you will have one question each. I'll start with Rajiv because you are boringly beautiful among this rest of them because you are not in the news. So tell us, what do you expect from Sundaram Finance post-COVID? Post-COVID, rest each of them has a sort of background and history. So for me, it's easier to ask the kind of question I should. But Rajiv, as I said, you are boringly beautiful. So tell us, what post-COVID world for Sundaram Finance?
I think we aspire to continue to remain quite boring and hopefully out of the news. I think we continue to serve our customers to the best of our ability, which has been sort of the ethos with which our late founder chairman founded us back in 1954. You will likely see more use of technology, digital and data, but not in necessarily improving the customer experience through technology, but in helping improve the productivity of our people. Because our firm belief is the human touch, the Sundaram experience is what differentiates us. And so, we tend to celebrate in the triumphs of our customers and mourn in the tragedies of our customers. And so that is best done physically and can't be emulated or simulated on a digital device. So our sense is we will continue to remain quite physical in the way we interact with our customers, but we will put technology, digital and data to much greater use in enabling our frontline employees and other employees work with our customers, delivering that Sundaram experience much more. But overall, more boring stuff, no cowboyish antics, and hopefully strike that balance between growth, quality, and profitability to the best of our ability.
Thanks, Rajiv. So it's something different. Rajiv believes in more human touch than tech. Other extreme, probably Sachin Bansal. Tell us what to expect as and when you get the banking license. And touch wood, you would probably get it. It's a question of time. So if you as and when get it, what kind of bank you are planning?
Yeah, Tamal. So we believe that customers in India don't get a great experience from the banks today, right? So banks are not as customer centric as what you see the best organizations in other sectors that you see, right? So, I mean, whether it's airlines or shopping or anything else, right? So we believe that banking can be a delightful experience and we want to get to that. Another thing is that there is a lot of underpenetrated or underserved users in the country. There are people who are credit worthy and they don't get access to credit easily. And we believe there is no way a human touch or human workforce can get to that level, to the level of penetration that the country needs. We need to leapfrog that and we need to go to digital to be able to enable these users. And we believe that credit and banking is a purely virtual product. There is no physical delivery of the product at the end of the day, right? It's not like taking a cab or ordering food or shopping online. There is a physical element involved, but there is no physical element in this space. So it can be purely virtually done. Customers can get a lot of control over their life, their finances, and with the right tools, they can be enabled to make very sound decisions and control their financial kind of life much better, right? So we want to get to that level. We believe that will unlock scale. What companies like HDFC and ICICI and others did in 20 years ago to the banking sector. Something like that needs to be done again with the new technology and the new way of thinking. And we want to bring that.
Thanks, Sachin. It's a pretty daring comment, I must say. I mean, Navi FinSub must have their banking lines, right? You are just sitting there and being recorded saying that bank's customer service is pretty poor. So your banks will get upset. Your lenders could get upset. But yeah, you probably have told the truth. So let's hear Jairam, the new avatar of Diwan Housing. What do you expect from it? I know it will have a different name, but tell us in terms of business philosophy and products, what would very quickly, 1 minute.
Diwan Housing was the original player and the original leader in the affordable housing space before affordable housing was chic. And so that is the root of that company, and it will remain the core of what we try to do. So we plan to build a multi-product retail lending business with its center around affordable housing. So we will certainly have an affordable housing business as a key pillar. But outside that, we have an MSME lending business which we plan to grow and make all Diwan Housing branches multi-product branches, also selling MSME lending products. So that's the second element we are going to look at. We are looking at other sort of product categories which are not the darlings of banks. So used car financing or education financing, and some of these other businesses which banks tend to not love that much. So we will try and plant our flags in some of those businesses as well. And finally, we have a lot of focus in digital unsecured lending in various form factors. So we have a fairly large effort going on right now, and a large number of partnerships live where we want to do end-to-end digital unsecured lending in very small ticket sizes.
Okay, thanks, Jairam. So we're left with Gagan and Jaspal. Let me keep Jaspal as the last speaker because your new bank is imminent. Before that, Gagan, tell us, you had a difficult time. You wanted to take over a bank, which did not happen. So what's the future looks like? Because there have been in the market, we get to hear that probably you will exit the business or reorient yourself in a different way. If you want to say something.
No, we're not exiting any business. We are here to stay, and we've done a lot of hard work the last 20 years to not exit. Management is fairly focused on growth. Just that in the past, the whole model was to compete to basis the credit rating, do either niche lending or mass lending. But in some ways, we used to think of the competitive landscape to include banks. Now we believe that we have to focus on the number of customers that we cater to, the lowest cost income ratio that we can arrive at, the user interface that we can provide to those, and collaborate with banks and facilitate the growth of the retail book of the bank, whereas we become their partner. So that's really the next chapter for Indiabulls. It's already well underway, and we are already in this model starting to hit moderate scale. I'm quite confident that by the end of fiscal 23, we will be doing very similar numbers to what we used to do back in 2018.
Good to hear, Gagan, the new chapter in the Indiabulls business. Last word is yours, Jaspal. As you yourself said that it's only a few days away, the launch of the new bank. As a customer, PMC is a separate issue altogether. But yet another small finance bank, lovely name, Unity Small Finance Bank. Tell us, I mean, what would be your business model? How is it different from others? And what is there for me as a customer? Sachin said the banks don't care much about customer service is poor, so on and so forth. So tell us.
So let me just set some context. Centrum has Vintage as a financial entity, but it was for the bulk of its life a fee serving in a fee serving capacity. And only 3 to 4 years ago, between 4 years and 3 years ago, we started the lending verticals. Even at that time, our view was that we want to eventually converge into a bank. So we were never in the camp that was weighing, is NBFCs better given lower reserve costs, lower regulation versus, banks have some challenges, but they have a deposit franchise. We always knew we were going towards a bank. And in fact, but the going was good in 17, 18. And then in 19, we made a very clear decision that we have to go to a bank as quickly as possible. And actually, we had 6 very serious discussions between a couple of SFBs and a few old private sector banks and even one cooperative bank which was undercapitalized. I'm really pleased that we could escape the media scrutiny on each of those 6 conversations and not get reported. But we were very clear. And then, of course, Destiny had PMC for us. And so that's where we ended up. And we are quite excited right now because firstly, we're going to have a new licensed entity. It's the first entity after quite a while. I'm sure there are many more in the coming. And that is not disturbing in any way because I think, as everybody has reconfirmed here, the market is extremely large. We've chosen to go digital for the 2 reasons that Sachin mentioned, reach and customer experience. But equally importantly for us was the ticket size issue. To be economical at a small ticket size, which is where the bulk of the growth is going to come from, you need it to be a 100% digital player. And that is what, and I think we have put our money where our mouth is. We've given away 50% of the partnership to a fintech. If we were partnering with a PE or a family office, we would have given no more than 10 or 20%. But the fintech not only brings the capital, but it also brings business acquisition and it, most importantly, brings a mindset of technology, which I think all of us need more of. Barring Sachin, who's proven. Okay. I think the rest of us, all of us can do with more of that. So I think that's really what we're looking forward to.
Thanks, Jaspal. It's pretty unusual to hear a banker talking about destiny. So PMC, it's pure destiny that PMC has come to Centrum. So anyway, thanks all of you, Jaspal, Sachin, Jaram, Rajiv, Gagan. Quite an interesting animated discussion. We could have gone on and on, but there are many questions. Next 10 minutes, we'll have quickly take a few questions. So what is the key takeaway? All of you agree that yes, indeed, it's advantage NBFC. In fact, it's more than that, it's advantage Indian financial sector. We need more banks, we need more NBFCs, and the playing ground is pretty fertile at this point of time. So the nightmare of 2018 is behind us, and hopefully even the nightmare of COVID pandemic also should be behind us, barring unforeseen circumstances, the so-called third wave will hit us. Otherwise, everything is pretty good. Credit is picking up. New products are being distributed. And you are gearing up. Some of you, 2 of you are, one is seeking a license, another is readying for a bank. And each of you in their own way is ready to reinventing yourself. And what Gagan is said particularly interesting is this: there's no more competition. You people have learned, so it's more a sort of collaboration with the mainstream financial system. So that's it from my side. Let's take a few questions. There are many more. There's a question from Mr. KK Mittal. Who wants to take this question? Can lending caps on NBFCs? What's the impact of the lending cap on NBFCs? And this gentleman is referring to two reference. One is RBI capping IPO financing to rupees 1 crore per borrower from April 1 next year. and also earlier rupees 50 lakh cap imposed on P2P NBFCs. Yeah, anybody, Jaspal or Jairam?
So let me start in the reverse. The P2P 50 is big enough, so I don't think so that's a problem. Most NBFCs who are doing P2P are doing smaller ticket than that.
The first one and the IPO financing is Rajiv.
Yeah.
Jairam, do you do IPO financing, Jairam? Yeah.
Yeah, no, see, IPO financing is, 1 crore is, again, is a fairly significant limit. I can understand where the regulator is coming from, that there's a lot of speculative IPO activity and, all looking for first day pop that you're seeing, and they want to clamp on it. I think that's fine. This is not a big part of any NBFC's business model, right? It's a very, very, very short-term business, and it's very occasional. So nobody has built an entire business around it. So I don't think it makes a big difference to the sector overall.
Okay, this is a specific question again to Sachin Bansal. I think you have already we have already discussed, but still, this is from Hemant Sultania. How has your microfinance portfolio performed over the past 2 COVID waves? Could you throw some light on portfolio quality?
Yeah, so Tamal, as I said, so our portfolio has recovered quite well, and even the loans that we had written off are now coming back and becoming current. So, I mean, today is so good that we are better than pre-COVID in terms of collections and the demand that we have for the credit in the market. We are growing very fast, and also the nice situation that we are also facing is that a lot of microfinance institutions did not recover well. So there is a window for us to grow fast, and we are expanding and growing in those areas as well. States like Tamil Nadu, which were kind of slow or were kind of penetrated well so far and were not very conducive for new entrants, have now become conducive. So we are kind of entering on those spaces as well.
Okay, there's a question from somebody. The second name is not there. First name is Alka. What will be the impact of scale-based regulation over NBFCs? Will it prevent systemic crisis? Maybe Rajiv? It's a very theoretical question. Yeah.
Sorry, Tamal, I didn't catch the question. Could you please repeat?
The impact of scale-based regulation which RBI is introducing.
I think it's a progressive move, very much in line with the remarks that Mr. Vishwanathan made at the start of this panel discussion. I think it brings a lot more level playing field across many dimensions of supervision for the larger NBFCs. Allows us to actually be supervised in a sort of uniform way, similar to how banks are getting supervised. And so it's a progressive move that we are looking forward to actually.
Well, we don't have too much of time. Let's quickly take maybe two or three more questions. Not that there are many more. One is, I don't know who wants to take this question. It's a pretty tricky one, not concerning you, but about the system. How do you react to the recent regulatory action against the SREI group in Kolkata? Is talking about. Does it cast a shadow on the function on the sector? The question is asked by M. Vasant Krishna. Anybody wants to say anything? The RBI action on SREI group, does it cast a shadow on the NBFC sector? Is it too negative? No? Yeah, Jaspal?
Kamal, there is no doubt that just as we've seen in the past with ILFS and some of the others, there is going to be some negative impact on the sector. But what it is also showing and saying, because not just on SREI, the auditors have been also dealt with quite harshly. And every day now in the newspaper, we see the regulator putting fine even on the very big banks in our country. So I think there is a seriousness about compliance with the RBI, which is kind of unprecedented in the past. So I think that's the only message you take away. The consequences, of course, we will face.
Okay, Rajiv, I see you nodding. So, anyone to add anything?
No, I think we are moving in a regime which is actually putting the guardrails for all of us to behave quite responsibly. And some of the moves that people may have made over the past couple of decades, when perhaps supervision was not as rigorous or the rules were perhaps not as clear, the signal very much is that looking ahead, there is going to be very clear, consistent, and strict supervision. So again, reflecting on the remarks of all the panelists so far, I do feel that the guardrails have been set up well. It's for us to behave, and if we misbehave, I think there's going to be very strict consequences.
Okay, there's a related question. Anybody wants to know, or whenever wants to answer, any of you? How serious are the governance risks in the sector? I mean, it's a classic question, but anybody wants to respond? Jairam? Yeah.
See, I think financial sector, I think somebody mentioned this before, the financial services sector is this is by a gentleman called Ashok Pradhan. Mr. Pradhan's point is right. Like there is the foundation of the financial services sector is trust, right? And the way to institutionalize trust in a corporate environment is corporate governance standards. So you've got to ensure that the corporate governance standards of financial intermediaries, anybody with a fiduciary responsibility, is held extremely high, whether it is in the form of regulatory relationships, board composition, board engagement and independent directorship and stewardship of the business, etc. So I think not just in India, but across the globe, whenever governance standards have fallen in amongst entities which are financial intermediaries, trouble has followed. It has either been through the regulatory route, or it has been through the credit rating route, or it has been directly through the lender route. But one way or the other, trouble has followed when governance standards have fallen. So it's, I think, in everybody's best interest to make the effort to keep governance standards high. I think Jaspal has something as well.
Yeah, Jaspal wants to add something, and then we'll take the last question. Yeah, Jaspal, please.
I quickly say that I would classify that into two categories. I think Gagan talked about ALM mismatch, about no buffer in liquidity, etc., some business model imbalance, etc., which has also led to, is obviously a result of poor corporate governance. But there is the other category, which is what PMC has gone through and what Jairam's DHFL in the past has gone through. I think that is the one that is of a very serious and the one that one has to have no acceptance. I mean, that has to be a zero tolerance policy on that.
Thanks, Jaspal. So I'll take the last question. Yeah, I see Sachin Bampata is furiously sending me more questions. Sachin, don't need to send any question. We are just about to close. So the last question, Gagan has not answered any of the question, but he has hinted at something on this line. So I'll ask Gagan to answer. This gentleman is Hek Awood is asking that, even if it's Advantage NBFCs, how do you actually ensure the growth is sustainable?
Growth really is going to be an outcome of how well each NBFC manages the liability and the capital side of the business. The asset side is fairly there, and the growth on the asset side is. So each one of us has to basis our legacies, basis our capabilities, has to figure out what is the most efficient liability mechanism. And if we get it right, growth is sustainable. If we don't get it right, there would be volatility. If we get it horribly wrong, we will go towards existential risks. So it is essentially a liability side management business. If we do it right, then I would imagine the next 10, 20 years is non-stop growth.
Thanks, Gagan. So anecdotally, Jaspal spoke about destiny, and Gagan, I think, thrice mentioned about existential crisis or something to do with existence, whatever that means. So that brings us to the day 3 of Business Standards 11 event 9-day series. Today we discussed is it Advantage NBFCs. Thank you and goodbye from my side. Over to you, Manish.
Thank you, Tamal. So the answer to our sessions theme today is a clear yes. Thank you, dear panelists, for all the insights. And thanks again, Jana Small Finance Bank, our partner. To the audience, many thanks. The next session is on your screen now. Wednesday, 4:30 p.m., we will have a keynote speech and panel discussion on small finance banks. Please join us. Goodbye for now. See you on Wednesday. Thank you.